Howdy. Welcome back to Dion Talk. 5 trends that are dying in 2022. And 1 bonus. The purpose of my content is to help you, the average person, understand that you can reach financial freedom in 10 years or less and make work completely optional, even if you're not starting from the best position. There have been a few things that changed in the market this year, and I'm not saying that the 5 things and a bonus that I'm going to talk about are never going to happen, or that some people might not be successful at them. What I'm going to talk about is trends that are dying, meaning that these won't be done in large numbers by a lot of people who don't really take the time to learn the strategy and then be successful at it. There will be some people who pull them off, but on a large scale, what I'm going to talk about is going to be a lot less than it was the last couple of years. There may come a time in the future where these start trending again.
But not today.
The first trend that I want to talk about that is dying in 2022 is the move-up buyer. The person whose family has grown and wants to buy the bigger house. The person who's making more money and wants to buy the bigger house. There are a couple of reasons why the move-up buyer isn't going to be trending this year. The first is a lot of us are trapped in a rate lock. In the last couple of years, interest rates have gone down so much that either we purchased a house and have that low 30-year fixed rate debt, or we bought a house several years ago, and in 2020 or 2021, we refinanced to a better rate. Again, locking in our debt at that low interest rate, in a lot of cases under 3%. So that person now that wants to do a move-up buy is going to buy a property that costs more because it's bigger, that's the move-up part, and the interest rate is double, making it much less likely that a lot of people are going to be move-up buyers like they were for the last couple of years. The second and third trends that are going to be dying in 2022. Again, I'm not saying people won't do this. I'm just saying that for the last 10 years, these 2 strategies have been a lot easier to pull off. You can actually make mistakes and the market would cover up your mistakes for you. That's not happening now. The first one of these 2, so the second one in my list of 5, I'm confused, are you? Is the BRRRR method. That buy, rehab, rent out, refinance, repeat method that a lot of people give a lot of attention to. If you're familiar with my content, you know that I have suggested that a few people shouldn't use this as the starting out method because it was possible to underestimate or overestimate your after repair value, not get the timing right on how long it was going to take to rehab, especially in the last couple of years when we had delays in supply chain issues. Then refinancing could be an issue. That's what's killing it in this year and making this trend die, is the refinance portion. A friend of mine, Millennial Mike, purchased 2 BRRRRs about 6 months ago, and he's at the point now where it's time to refinance and interest rates are double where they were when he started. Now you can plan for rates to go up a little or down a little, but having them double on you, that's not great. So for the last several years, you could start a BRRRR project, have delays in your rehab, you can get your after repair value wrong, and then wait a month or 2, and prices went up so much because there was so much demand with the low interest rates that your mistake was covered. This is the same reason why the third on my list of 5 and the second of these 2 that are very similar is dying is flipping. In an uptrending market like we had for the last decade, flippers could really make some mistakes, and 2 or 3 months later, the increased price and the demand could cover your mistakes. Well, now, the point of interest rates going up is to slow the market to help curb inflation. Well, slowing the market means destroying demand. There are some things going on that is destroying supply, like they're not being move-up buyers, but it's really hard to flip a property when you were counting on prices to be at a certain point by the time you've finished. And for the last several years, just like the BRRRR strategy, if you make a mistake and it takes you a couple of more months to sell, prices increase so much to cover up your mistake. Well, now prices are down month over month. In some markets, I think 3 now, they're down year over year. That makes it really hard to flip when you were counting on price increases and counting on there being buyers. A lot of buyers disappeared when rates doubled. If you're going to buy a property and the interest rate is 5 or 6%, it's a lot more expensive than when the interest rate was below 3%. With the BRRRR method and flipping, there are a lot of unpredictables, things that we don't have control of, that make it a really risky strategy in a market like we're seeing in 2022. I'm not saying there aren't people who are really good at these two strategies that are going to do some amazing deals this year. What I'm saying is that if you're starting out and you're looking at the BRRRR method or flipping to get started, you might want to rethink that. And at the end of the video, I'm going to talk about some things that might help if you decide to go that route anyway. The fourth trend that is going to be dying in 2022, out of my list of 5 and a bonus, is new builds. For several years now, we haven't had a lot of entry-level home new builds. Most of the new builds have been in the move-up buyer category, the $600,000 to $900,000 houses, because that's where the profit margin was. Right now, with interest rates so high, buyers have disappeared. Current builders who started projects 4 months, 8 months, 10 months ago are finishing projects and don't have a buyer. They're having to cut the price from where they wanted it to be to what they're going to be able to sell at. How many builders are going to want to start projects in a market where current builders are having to reduce their price? Out of the last 10 years, we had the least number of builds done in any 10-year period for several decades. So we have a limited supply. So that would motivate people in the last couple of years that would trend new builds. We had high demand, low supply, low interest rates. Now we don't have the low interest rates and we don't have the demand. So new builds are going to be a lot less than what we've been seeing, even though it's been a lot less than we've seen in the decades prior to the last 10 years. The fifth, the last trend that is going to be dying in 2022, and the bonus, is refinances. Pulling money out. A lot of people call this equity. What I call it is creating debt on an existing asset. But if you could pull money out, do a cash out refinance at interest rates of 2 to 3%, and then redeploy those for a good return, it made a lot of sense. I actually had my friends, Michael Zuber from One Rental at a Time and Matt the Lumberjack Landlord for the last year, actually trying to peer pressure me into cash out refinancing a house that I had that was paid off. I chose not to because our strategies are different, and it's okay to have a different strategy. There is no one right way to invest in real estate and reach financial freedom. There is a one right way for you. And for me, that is the most amount of cash flow with the least amount of units. For them, it's a lot of units with more cash flow than I have. So I understand the appeal of their strategies, but I didn't want to take the equity out, which means create debt on an existing asset. It would have made sense to do it when interest rates were 2 or 3%. But now at 5.5%, at 6%, it really doesn't make sense to pull money out at that high of an interest rate. Cash out refinances have dropped 75% year over year. That is a dead trend. That doesn't mean people aren't going to do refinances. It just means it's not going to be trending. Those are the 5 trends that are dying in 2022. And I have some strategies that might help you if those are going to be trends that you go for. Here's the bonus. Here's the thing that's really changed that's different now than it has been for the last 2 years. For the last 2 years, speed was your friend. There was so much demand. Prices were going up, interest rates were still low, and a lot of sellers were selling because the prices were higher than they thought they would ever go. And they thought, if I can sell my property, I will. But some sellers didn't believe their agents about how much they were going to get. So speed was your friend. If you can get an offer in a few hours or less, sometimes you can get an offer accepted like I did in May of 2021, because I had the offer in a couple of hours. That listing agent and that seller accepted my offer before the seller knew that they were going to become inundated with offers. Some over asking, mine was at asking. Some waiving contingencies, mine had an appraisal clause and an inspection contingency. So the faster you could react, the faster you can get your agent to submit the offer, the faster you can get your lender to give you your letter of pre-qualification for the amount of your offer. All of those things lining up as fast as you could was your friend. Now that we're seeing demand go away, we're not seeing as many. There's still 38% of deals last month went over asking, but not as many as we had before. We saw the highest I remember seeing was 52% of offers going above asking price. Speed is not as important now. Actually, what might work out in your favor now is watching days on market. If in your area it was normal for a property to be on the market 1 or 2 days and then be under contract, and you start seeing properties that hit 10 days on market, it might be time to make a significantly lower offer than what they were asking for. If average in your area was 10 days, you might want to wait till 20 or 25. You want to see days on market pile up to significantly more than what was normal for the last couple of years, because you might not always find a motivated seller, but that's how you're going to find one if they exist, is by making an offer that's much lower than what they were asking for after enough time has passed that they didn't get the offers they were expecting to because their friend sold a month ago in 2 hours. It's a shifting market. So here are some things you can think about. First, if you're that move-up buyer, there is a strategy where it will work successfully even in the current market. Remember, a lot of people are locked into their current mortgage with a low interest rate, and home prices are still high. So if you're doing a move-up buy, you're buying a more expensive place with a higher interest rate. You might be able to capitalize on the gains of your property by doing if you're an owner-occupant, moving to a less expensive area. This is where a lot of people are moving from California or Seattle or New York to a state where the properties are 1/3 the price, and then paying more than what is normal for that area, but getting a discount compared to where they moved from. If you're going to be using a strategy like the BRRRR method or flipping, there are some strategies where it can be a little less risky. One of the risks with the BRRRR method, and sometimes flipping, is using hard money or money that has a timeline, where if you don't complete your project and refinance or complete your project and sell by a certain date, the cost of your capital goes up significantly. Maybe if you're going to do a BRRRR method, use your own capital. Maybe if you're going to flip, start with long-term debt, where if you had to, you could keep the flip as a rental. Like I said, just because these trends are dying doesn't mean that these strategies won't work going forward. If you're looking at building, instead of building a new build where a lot of the builders are pulling back because buyers have disappeared, maybe adding ADUs could be a better strategy, because we actually have a government almost nationwide encouraging people to add ADUs to help assist with the housing crisis. And anytime you go to tap equity, to add debt to an existing asset, my first question, before it's even, should I refinance? Should I cash out refinance? Should I get a second mortgage? Should I use a home equity line of credit? Should I sell and redeploy the funds? My first question is, do you have an investment? Not a toy, not a boat, not a trip, not something that you're not going to benefit from financially, but an actual investment that's going to get a return that justifies the added debt to the existing asset. There will be some people who find a deal that is so good, it's worth taking out a home equity line of credit, getting a second mortgage, maybe doing a cash out refinance, even though it increases the interest rate on the existing debt, to buy a deal that is worth it. But I would not touch that equity, adding debt to an existing asset, unless I had the deal and I had confidence in my ability to land that deal. Not just a theoretical, I think I could find a deal that justifies it. You actually know of the property or the asset that you're going to buy. And I hope the bonus really helps, because this is a shift in the market that doesn't quite make it a buyer's market, but it's not as strong of a seller's market. And as days on market start to add up, you might be able to make offers where the numbers make sense to you, even with increased interest rates. Let me know in the comments below if you enjoyed this list format, or if you think I should have tried to pull this off on the slides completely out of memory. Until my next video, thanks for coming to my Dion Talk.
We're sorry, the number you have dialed is not in service at this time.